Hi, so welcome to our demo lecture on operational risk management. So these are the things that we would be covering in today's demo lecture. That is risk management history, of course, kind of story, but it's good to know that what was a background and where we are standing together, how it is linked to the history, and of course, a definition and Basel II risk capital approaches. What are different risk approaches? So there are many banks in the market, so few are still in the developing stage, so they follow something. And the thing, banks which are already developed, they have very well sophisticated systems, so they follow some different process. So just a high level summary. And why data collection is important, mainly internal loss data and categories of Basel II operational risk management, and just a glimpse of how exactly approaches work when it comes to calculation of capital requirement and exercise. See, first of all, let me go back to previous slide, and then we can go through it. So, first of all, see the main main reason why banks have the risk management department is that they need to calculate the capital so that they can survive in the severe times, or when there are losses. So it's just, instead of being reactive, banks or financial system as a whole try to be proactive, because at the end of the day, with banks, it's common man money which get deposited, and it's responsibility of the bank and administration overall to protect the hard-earned money of the investors or the depositors, so that financial system doesn't collapse. So that's the main reason, because it may happen that if there is no governance or the regulation on the bank level, bank may end up having their own speculative strategies, or they can go for more risky assets and things, just for their interest of making profits. But that would be at a cost of depositors money, which systems and regulators and uh, as a whole we don't want, because that has a huge risk of collapsing the system. It is, I mean, you can just think of the financial crisis that happened way back in 2008, how the entire economy was collapsed across the globe. So that was a bit background. And if you have any doubts, just stop me there itself, I'll be happy to take. So uh, there is a lot background to it. I mean, we can go, back of 1988 as well, but Basel one, that is, it was implemented in 1988, wherein the capital was calculated based on only for credit risk. So if bank is disbursing some loan, then they have to keep aside some capital, so that if investors doesn't repay back their loan, then at least depositor money is saved. So that was way back in 1988. There were some amendments to it in 1996, because they realized that the books are not fair valued, so they are exposed to market risk as well. So there was an amendment in 1996 in Basel One itself, wherein they introduced a market risk aspect of the risk management, wherein bank had to uh, record the value of the books as on that day. Not really, like there are two things: fair value accounting and like just accrual based accounting. So that's where this market risk capital was not getting captured, and that was an amendment in 1996. And when we went ahead in 2004, it was a Basel II, which was introduced, and it had three aspects: credit risk, market risk, and operational risk. And these are the three pillars basically which Basel II had. So, like the main thing, the key thing about player one, that is a minimum capital requirement that I just gave you background in the previous slide. What is the capital that bank need to keep aside for the the bad events or something goes wrong in the system. And supervisor review at the same time, or regulator responsibility is also the regulator is also accountable to ensure that banks are working under norms stated by the supervisor or a regulator. And third thing is it's like a honesty is something which following best practices even if no one is observing you. So market discipline is something which states that bank has to upfrontly disclose if they have taken some additional risk in their some client or some new business strategy. So it's a market, you can say corporate governance. They have to ensure on their own to disclose everything to the regulator. And Basel 3 was just after 2008 crisis, wherein there were a lot of Lawback, see, it's a risk management is an emerging space wherein events keep happening, leaving us with new learnings, findings. So that's where this keeps coming. Currently, there is Basel 3.5, 4 also, but for our scope, we have kept it till Basel 3, wherein we have remediation from financial crisis of 2008, wherein more stringent capital requirement was stated in Basel 3, including on its main on the equity and higher capital buffers. So if bank wants to enter into high risk strategies, they had to ensure that they need to have more equity capital. So like just to hold bank back to enter into the high risk strategies from the depositors' money. Any
Mhm.
doubts on this slide?
No, all clear.
Cool. Let me know. I mean, once you have comfort. Otherwise, just we'll just walk through this tech and I will wrap up. So it's a
Yeah, now the definition is I'm aware of it. I wanted to go through also. Like, okay, definition, risk definition. This is I'm familiar with. If you go to the next, let me see what is.
sure,
I
please.
wanted to go to the slide where, or the topic where you about the internal lost data, something like that.
Okay, yeah,
Can I see this one? What is this one? Can you go back a little bit?
sure. So these are the approaches, different approaches used for calculating operational risk capital. So it is a
Mhm.
basic approach wherein you just take a 15% of average gross income. It was long back. Currently, like majority of the banks are on standardized approach or AMA. This is
Mhm.
new thing, very advanced one in Basel 3.
Mhm.
This was a slide you wanted to
ال-
have a look?
yeah, the this is I want to ask about something out the scope. The value at risk.
Hmm. Yeah.
Do you guys teach uh, like how to do it? And the Monte Carlo as well. Do you guys have like a separate subject to teach how to do the Monte Carlo simulation and
See
the
more.
value at risk?
Yes, we do have. In fact, these are the part of. So if I talk about Monte Carlo, it's a part of paper one, uh, level one, paper two, that is quantitative analysis and value at risk. So the topics are included, and yes, of course, we do take care of those things when we take up those papers. So yeah, certainly
It's
can be
included,
done.
you mean, in the FRM?
Yeah, that's correct. But if you want, you
Oh,
can we can have it for your customized certification that you were talking
y-
about.
okay, yeah. I might discuss with you this later after.
Sure, sure thing. Yeah,
Okay. Yeah, we can go ahead. Okay. The next one. Risk measurement and modeling, risk reporting.
yeah. These are the
Okay.
categories of. See,
Yeah,
you need
yeah,
to have some work frame if you want to collect the data. You need to have some
yeah.
kind of work frame. So these are the categories as per the Basel
Yes.
2.
Yes. Okay. All right. Okay, here is what it turns to frequency distribution.
Yeah.
Mm.
So see, there are two things wherein like frequency distribution. Like if I talk about internal frauds or external frauds, In each business line, what is the probability or occurrence that, like say for example, in trading and sales, if we close out 100 deals, in out of 100 deals, uh, there is a one deal wherein there is a scope of internal fraud, likewise external fraud, and there are various categories, and these are the business line at which this distribution is captured. And likewise we have for severity, like if that internal fraud occurs, what is the percentage of total loss? So you will have the entire loss calculation for across business line and across categories. So what is the percentage of, say for example, if I incurred 100 loss across these event types and business lines, what is the percentage of loss coming from the internal fraud? Because internal fraud is something like your employee might be involved, and so that is the percentage relatively higher, so 11%. So 11% of that 100 unit loss is coming from the trading and sales and internal fraud. So likewise the severity of all the business lines and categories calculated, and then we have further calculation of operational risk. If you want to have a look, we have small example here. So this is a kind of data, like this is a frequency
Yeah.
distribution, number of occurrence, and what is the probability of that number of. See, let me tell you something very holistically. If you are aware, there are hurricanes in the United States. So if there is some zone in US which is like hurricane doesn't come that frequently, but it when it comes, it comes with a very high severity. The amount of loss is very high when it comes. So that's where frequency and on the other hand, if we have some other zone wherein hurricanes are quite frequent, but when it comes, losses are not that great. So we are like we the strategies for both things would be different, and we can capture the expected losses. Likewise, in we can have it for various business lines and the categories that I shown you, internal frauds and like business lines, trading and sales. So we can identify which are the business lines which are more exposed to the operational risk. So that's where this work frame is done. I mean, across, say for example, bank has a head branch, so they capture it from their entire subsidiaries, this data, and at a bank level, this is done. So frequency distribution is plotted and the severity distribution, and you are asked to calculate what is the expected loss from uh, this this data. So that's how this come. Of course, there would be some elements which are not captured. So this is how this is done. Expected frequency is number of occurrence time probability. Likewise, we can have the expected value for the entire frequency distribution. And for severity, it's like $1,000 yours, but probability of this is 0.5%. So zero point 0.5 times your 1,000. Likewise, so if you notice, there is one item stating $1 million loss, but that probability is 10%. Unlike this, like $1,000 loss has a 50% probability. Like, so if you have 10 days, 10 days, you are exposed to $1,000 loss on the 5 days. Likewise, for 1 million, it's just a one day. So you have to give these probability as a weight to this dollar loss, and this is expected severity that may happen. But $140 approx $140 uh 140K dollars, and the probability of this is zero point 0.5. So 50% of this. So overall, from this data, you can expect the loss of $70K uh, from this one.
But can this is the 0.5. How did you get it again? Sorry.
Sorry, how did?
Here, the last one. The expected loss is therefore
Yeah. So
0.5.
this is 50% is your expected frequency that's coming from here,
Okay, that's frequency. Yes. Okay.
and this is a severity. So like if something happens overall, so what is expected severity? I mean, if
Mm-hmm.
I have this data, what is the overall expectation of loss? So it's
Mm-hmm.
$140 K, $140,000 approximately, and ha
Mm-hmm.
the probability of having this loss is 50%. So overall expectation of the loss is 70,000.
Uh-huh.
So see, when we say I'm tossing a coin, so there is a
Mm-hmm.
50% probability. So if I tell you that I'll give you $10 if say you give a call for a head, and tell you that I'll give you $10 if your call
Mm-hmm.
goes correct. So
Uh-huh.
what is the expected value that you will get? So $10, but having a head has a 50% probability. So amount that you can expect out of this event is $5. So 50%
Uh-huh.
probability and $10 when it comes true. So 50% times 10 would be $5. That is expectation of cash flow from the deal that we made just now.
Mm-hmm. Okay.
So that's how
Okay. Clear.
this thing, basic probabilities are used when you calculate operational risk manage capital or expected loss. Of course, there is a more to it, unexpected loss and other stuff, which we need a little more depth about quants. And of course, when you cover war, value at risk, that those things of basics of quantitative analysis also will be already covered in that.
Mm-hmm. Okay.
So this is what I had. Any question on this content? Else, otherwise, I'll stop recording and we can continue discussing further.
Okay. Now the information this above, it's based on the historic. Yeah, for example, it's an example, I know, but it's based on the historic, or it's like fixed,
See,
or just an example.
what I shown you in above, that frequency distribution and the severity distribution is based from the past data. Source was mentioned. I'll share the recording with you. You can just have a. It's a BCBI, that is Basel Committee of Banking Supervision. So on their website, they publish the data. I mean, periodically. So it was from that, and this is something which I think is just raw data. I mean, hypothetical, just for uh, just to make students unfamiliar with how the calculations are done for expected losses in operational risk.
Mm. Okay. Okay. Clear.
Fine. If nothing else on the content, I'll just stop recording and then we'll continue.
Yeah. Yeah. All clear. Nothing to comment on.
Thank you.
Clear.